Hey, welcome everybody. We're to Strong Valley September monthly market matters recap. We'll start off a little bit with what's happened in September. Hasn't been great, but that's part of market movement. So the S&P is down about 5% month to date, but still up about 13% for the year. The NASDAQ's down a little bit more, about 6.5%. Obviously, all your tech stocks, but year to date up quite a bit, with about 26%. The MSCI World, which is all the non-U.S. stocks, again month to date down about 4. Year to date it's up about 5. The Ag, which is all of your bonds, your fixed income index, is down about 2.3%. Year to date still down about 1.5%. And really the best performing for the month, although it was down about 0.5%, is your commodities, and year-to-date down about 2.6%. So that kind of gives you an idea of what's happened in September. It's been a little bit different direction than the rest of the year so far, and we'll get into a little bit of why that is. Chris, you want to start a little bit with the rates?
Well, just the fact that I think everybody's a little surprised that inflation's been stickier than certainly than we thought it was going to be. Some of that certainly has to do with fuel prices and cost of oil and cost of energy going up, which is kind of accelerated here at the end of the summer. So that's probably going to have the rates a little bit higher for a little bit longer than we thought. And originally, if you go back maybe 6 or 8 months from now, or from where we are now, I think we were thinking possibly fourth quarter or early next year that the Fed would, consider lowering rates. But I don't think that's going to happen. And consensus seems to be that it's going to be mid to late next year before they really get interested in lowering rates. And possibly, I've heard plenty of really smart people say that there might be an additional rate hike. We're at about 5.5% on the Fed funds right now, and what we see is that we're looking at not a lot of interest in cutting those rates until probably end of July of next year. So we're at least a year out, according to Fed funds futures probability. Sorry. So anyway, that's probably not a great thing for the stock market itself, in short period here, and again with inflation pushing up here at the end of the summer, that's probably got some serious impact on what you were just talking about with what happened in September.
Yeah, and obviously a lot of it is driven by, again, back to inflation. Bottomed out at 3%, but it's ticked up the last 2 readings. So the most recent reading, they were always a month behind, was in August, and it's up to 3.7%, which then causes the Federal Reserve to basically think that inflation is still too high. They're still targeting 2 to 3%. So then they indicate that maybe we're not gonna cut rates. We're gonna hold them higher for longer. And we talk about this all the time, but just so everybody is, again, aware, the market has already priced in expectations. So when they come out and say, hey, we probably might hold rates a little higher, maybe there'll be one more rate hike. Well, they've already priced in rate cuts because that's just the way the market works. They're an anticipatory, on pricing and how things are priced in. So when they come out and say higher for longer, they're basically, the market retreats because they've already priced in cuts, and now those cuts aren't going to happen. So one thing I will say is if you go back and look historically, the Fed's not very accurate out past a couple of months because things change. It's a very complex system, and dynamics change day to day, and so they can forecast all they want for 6 months, a year, 5 years. In fact, they do have forecasts out for many years. But they change quite a bit and aren't always very accurate.
Yeah, and with higher rates, part of our notes here is that's probably good for bonds going forward. As rates sort of plateau and then potentially even retreat next year, your bond funds and bonds that people own will typically do better. The exact same sort of market action that happens when rates go up, where bonds go down, happens on the other side when rates go down and bond prices actually appreciate quite a bit. So Again, over time, it's probably a good thing, good place to be is in bonds now. It's been a really rough place to be for the last couple of years, and
Yeah,
the frustrating part is that's typically where we want safe money, and that's probably hurt the most.
Yeah, rough for the last couple of years as far as returns, but also rough for probably the past 15 years as far as yields.
Right.
So, right now we just crossed the threshold of the highest real 10-year yields going all the way back to the financial crisis, end of the financial crisis, which is March 2009. So real yields, which again, real yield is yield minus inflation. It's great to have 5% yields, but if inflation's 8%, that's called negative 3%. So the real yield is the yield minus the inflation number, which again, I just read off. So yields are up over 5, inflation's, right around 3.7. So, real yields on the 10-year are at 2.11%. And again, that's the highest it's been since March 2009. I think we have a chart on that at some point.
Is that real? I don't think that's the real. Those aren't the real returns.
That is. Oh no, that's total bond returns. That shows the pain. Again, that's something Chris just mentioned too. The bond returns. This is historic in the fact that we've never, since they've tracked it all the way back to, you can see 1928, never had 3 consecutive years of negative returns, negative total returns in the 10-year Treasury bond, and we're definitely on target for that this year. But like we said, that sets up for probably good future. Here's the real yield chart. You can see the nominal yield at the top. Again, nominal yield is just yield, not taking into account inflation. And then the real yield obviously takes into account inflation. So yields are up, and Chris mentioned this a little bit, that, hey, for fixed income investors, the safe money that's kind of been a boat anchor on the portfolio doesn't return anything. Now that returns something. So if you're a 50-50 client, go ahead, Chris.
Yeah, no, go ahead.
I was just saying, you're a 50-50 client. You got, 50% of your money was in stuff before that, maybe the average yield was 1.5% or 2%, and now, maybe the average yield is 4 or 5. So quite a big difference on returns to conservative investors.
Let's bring that real yield chart back up again too, because March of 2009 is kind of a special period of time. That was really when the financial crisis stock market bottomed. I don't know. So
yes.
What did we say? March 6th, March 7th.
First weekend, March 2009. I'm pretty sure.
2009. Yeah. So it's interesting that the market tends to really rally off of that. Now that had a lot of special factors just to that period of time, but high real yield is usually a really good thing for clients, both in bonds and stocks. So that's something to seriously look forward to.
Yeah, and I would say, again, we don't have a crystal ball, but we will have, this for recorded for the future. I would say when you see three years of negative returns against something that's never happened with bonds, it's not a great sign now, right? If you're in bonds, but it's probably a pretty good sign going forward, because like we said, you're earning more on a yield perspective, and if rates go down, we're fairly sure that rates don't have a lot of movement to go up from this point. I mean, it could happen, but again, probabilities versus possibilities. Probably topped out on rates, maybe 25 basis points higher. Pretty sure in the future they're probably going to trend downward. That actually is a boost to bond prices.
Well, and we're not done with the year either. So
right.
We're going to have at least a full quarter to go. And what was it? What the number right now for the ag for the year is negative 2.5, 2.4, something like that.
Yeah, negative 1.5 for the year for the ag.
year to date.
Yeah,
that chart we were looking for or looking at had I think negative 2.4, but I mean it can move that in a week really easily.
For sure.
Bonds move so much faster than people really realize, because it's, again, in terms of the information that's given out to the public, for the most part, they just look at yields. So you see, the 10-year has gone from 4.3 to 4.7. Oh, that doesn't sound like a lot, but the price action in that is massive. And if we get a turnaround and it things freeze up a little bit and goes the other way, bond prices can move 1 or 2% a day is not unheard of at all. So again, fourth quarter coming up. We're just about to close out the third quarter. Fourth quarter coming up. Hopefully has some good stuff involved.
So we had a drawdown of about 5% this month, which I mean, listen, seems like a big number, and and the way we think, you think 5% this month, well, 5% next month, 5% the following month. Next thing you know, you're down 25%. But we have a chart that, I mean, drawdowns are a part of market performance. It's a very normal phenomenon. So you can see, obviously, every year is going to have a drawdown, right? Because drawdown, it means peak to the lowest amount. So every year is going to have some type of negative. But you can see most of the years, if you even just look at 2008 from 2022, I mean, most of them were above 10% for the biggest drawdown. I mean, every now and then you'll get a year like 2017 where the biggest drawdown was 3%. But you can see there's some pretty big numbers in there. And in those drawdown, obviously all years have drawdowns, and many of the years on the right-hand side are positive overall. So it's definitely a part of the way the market acts.
Yeah, no, it comes with the territory. That's why over time, over long periods of time, that's why stocks outperform bonds too. Typically you get, and that's the weird thing about where we are with interest rates right now, but typically you get return with increased risk. Not always, and it's not a 1-for-1, but typically, it's accepted. If you take more risk, you should expect more return. And that's again, the strange thing with where interest rates are, because short-term rates are so high, and specifically treasury rates. So in many cases right now, treasury rates are above CD rates. I won't point to anything specific, but it's really a strange time. And if you're investing short-term cash into those instruments, it's the richest it's been in a very, very long time. And again, even on a real basis where you're earning more than inflation, and that's just not typically the case. Typically, the case is cash earns less than inflation, or short-term bonds earn less than inflation. And so, that's been probably the biggest bright spot recently, is clients that have a lot of cash. There's really good opportunities to make money, and we talk about that just about every month right now.
Yeah.
But I don't think we're not going to talk about it. 3 years from now, we're going to be remembering, oh my gosh, you could get north of 5% on really, really safe stuff, and I think these days are going to be pretty short.
Yeah, I would guess that's probably a short-term opportunity. Again, why more risk typically leads to more return over a period of time. Stocks outperform, and then bonds typically outperform cash, because again, we go through another 3-5 year cycle. You have rates decline, bond prices will go up. Cash is just cash. Cash investments like short-term treasuries, those will come due, but the rates will just go down that you're earning. So while you may earn 5 today, in a year, maybe it's 4, maybe it's 3.5. We don't know.
Resetting at lower rates.
Yeah, resetting at lower rates, exactly. So, another thing, just to bring up, because I know everybody's interested in housing. Again, we don't have a crystal ball, but just to kind of update where housing is at. I mean, it's wild to think that the interest rate on 30-year fixed right now, according to bank rate, is 7.84%. So we're almost up to 8% mortgages on a 30-year fixed. It's the highest it's been in 23 years. So all the way back to 2000, the last time we saw mortgages at this rate, which,
by the way, that's a quote. That's a quote on a purchase too. So you're looking at another probably 1/8 to 1/4. So you're going to be over 8% if you're trying to do a 30-year refi.
Yeah, that's the cheapest money is the purchase. So as you can imagine, that leads to mortgage demand. Right now is at about a 27-year low. And that's a combination of factors. You got the fact that we've been through an incredibly low period of interest rates, and now all of a sudden rates are really high for mortgages. So most people, I've seen charts on this, I don't have one, but I think 90% of people with a mortgage are somewhere below like 4.5% with their mortgage. So now the fact that they're at almost 8%, nobody wants to get rid of their 4.5% mortgage, sell their house and buy a new one at an 8% mortgage. So the only thing holding up housing prices is extremely low supply. Again, I just mentioned that most people are locked into lower rate mortgages, so they don't want to sell, and we've been underbuilt for a while. So prices actually are still holding up well, and I wouldn't say increasing, but holding up well because of the fact that there is limited supply.
Yeah, and I was just thinking back to 27 years ago, we were actually in the 1990s, right? So,
yeah.
So that's literally last century.
Yeah.
I'm surprised nobody said, "Oh, this hasn't happened at all in this particular century." But
Good old semantics.
yeah,
This century.
exactly. That was in the '90s. It hasn't been haven't had that low of demand for mortgages since the 1990s, which is pretty crazy. But like you said, I mean, just anecdotally, people don't want to move if it means even lateral move, same price, same house. They're going to have to walk into a mortgage that costs 2 to possibly 3 times as much. It's really difficult. So that probably bodes well for home remodels. It probably bodes well for people just staying put for a while, and unless they're forced to move, and that's where it's a little bit painful. If you're forced to move, for, let's say for a job relocation or any variety of reasons, that's that's painful. So I think that's the numbers that you're seeing as far as low demand. That's really how it reflects.
Let's be clear. We're not suggesting a home remodel. Husbands, don't kill us out there. We're not saying that we should remodel the house, but if you happen to want to, that's
a pretty bad idea.
It's completely up to you.
Personally speaking. Yeah. So that let's wrap up mortgages there. I don't want to talk about that anymore.
Yeah, for sure. So, Chris, you want to talk about the Secure Act? So this is another. So we're getting into kind of our timely topic stuff, things that are happening in the economy, in the market right now. Secure Act 2.0 has some interesting details.
Yeah, so we've talked about this a number of times over the years. I would say probably the last 3 or 4 years, as required minimum distribution ages kept moving up. So going way back, 70 and a half was the benchmark. When you turned 70 and a half, you had to start taking money out of pre-tax IRA type, 401k type accounts if you were retired. And Secure Act 2.0, which I believe was passed last December, right? So you're talking December of 22, and there's been, when they pass these acts, they basically push it down the road and go, okay, well, we're going to have additional guidance from the IRS and Department of Labor, and that's what we're starting to trickle in now. So really, eventually and over time, that RMD age is going to move all the way up to age 75. But for most of our folks that are not yet to age 71, 72, it's actually increasing to age 73 in 2023. So if you're not in RMDs yet, say you're 68 years old and you're looking down the pipe and saying, oh, well, I'm going to have to start taking money out, 2 years from now. Really, that number has moved to age 73 in 2023. And there was a little bit of relief on penalty. So again, traditionally, the penalty for not taking your required minimum distribution was 50% of what you didn't take, and then you had to take it also. So it was really, really punitive, and they've backed the penalty down to about 25%, and in some cases, there's additional relief to get it down to 10%. As a rule, we do not miss RMDs. You do not want to get into that space at all. Take your required minimum distribution, do it on time, which, by the way, just is just before December 31st. You just have to have your number satisfied by December 31st, and you'll be in good shape. And so if you have questions about RMDs, just pick up the phone, call us, or shoot us an email and go, hey, what's my specific situation? What age do I need to be at, to have to start taking that money out? But definitely do not miss your requirement minimum distributions. A couple other quick pieces on that. There's additional guidance around catch-up contributions. So for folks that are maximizing how much they can contribute to their 401ks, workplace accounts, or if they have a personal 401k set up, the catch-up contribution numbers are going up. So for people 50 and up, you're going to be able to contribute even more. There was some talk. And again, this goes back to guidance from Department of Labor and IRS. There was some talk about requiring those to be those additional catch-up contributions if you're over a certain earning amount, to make those all Roth. And the translation for that is, yes, you
pay
can
the tax,
put additional money in your plan, but you got to pay the tax this year on it. And that's been pushed off until, I believe, 2024. So January 2024. Catch-up contributions are going to be pushed for anybody earning over $145,000. has to be made on a Roth basis. They were talking about doing that this year, and it changed a little bit. So that's actually a little bit of good news for the rest of 23. But going into 24, for when you get above a certain age and certain earning amount, you're just going to have to be making those contributions. Those catch-up contributions are going to have to be in Roth form. And then for business owners, this is interesting too. The tax credits for starting up a new plan. So in the state of California, essentially these days you have to have a plan. Either you have a private plan set up, or you have to use the state of California's mandated plan. And so for most of our folks, they don't want anything to do with having to deal with a big governmental agency and all the paperwork and compliance that goes along with that. So most of our folks set up a plan. And for those that are starting new businesses or need to start up a new plan to be in compliance, the tax credits have been wildly expanded. So I won't go into all the details because it's 4 bullet points and you'll probably fall asleep by the end. But suffice it to say, they will through tax credits, you'll have most of, if not all of your costs to set up a plan and really get it launched will be covered, and you'll be able to recoup in the way of tax credits. So if you have questions about that, again, reach out to one of us and ask, because we can walk you through the whole thing. And it is the feedback we get from clients is that it's much better to have your own plan than it is to deal with what's referred to as Cal savers, and at least for those folks.
For sure.
Yeah.
I think the Cliffs Notes too. If you remember Cliffs Notes, that was back when we were in school, and you got the book, and it basically gave you the shortcut. If you didn't actually, if you didn't actually read the book, I don't think they exist anymore. Yeah. But the shortcut on this, and us giving you some update on the Secure Act 2.0 is just understanding the rules of the game and playing by them. You can get way ahead. And again, this is not your job. This is our job. So if you know that you can contribute more money via catch-up, or you can start up a plan and get tax credits, again, not a tax deduction. Tax deduction costs you money. Tax credit is free. It's a completely different distinction. So, and everybody talks about deductions. That's great. You get to save, some of the tax money, but you still spend money. Tax credit's free. All the different things that we just went through there on the Secure Act. If you know the rules of the game, then you can play by them and take advantage of the system. That's what we're trying to help our clients do. Again, tax avoidance is legal, tax evasion is not. So we want to do the things that are written into the rules, but a lot of people, I guess I should say, Americans, a lot of people that play by the rules, we all play by the rules, right? They just don't even understand what's out there and what options there are. So hopefully that gives you just a brief idea. That was just a couple of things from the Secure Act, but we're here to try to help clients, take advantage of everything they can possibly take advantage of, obviously within the rules.
Yep, for sure. So you want to talk a little about colleges? It's so I think it's FAFSA timey too.
Yeah, I thought this was interesting. So here's a chart on best value colleges. Again, this was from the Wall Street Journal. And the reason I thought this was interesting, I'll just mention, is because we talk to clients about this stuff all the time. Cost is one side of the equation. Benefit is the other side of the equation. When you subtract, we do the math on cost and benefit, you get value. So value is really what you're looking for. I'm not interested in how much I'm paying or what I'm getting if I'm paying a lot, right? I mean, you could get $100 and the fee could be $85. Well, that's a net of 15. Or you could get $20 and the fee is 1, and that's a net of 19. I mean, which one's better? We're more interested. We have a joke that, it's not what you make, it's what you keep, right? So this was a chart in the Wall Street Journal about the best value colleges. And so basically the cost of what it costs to go to school versus, I'm sure it's an average starting salary from graduates. And again, take this with a grain of salt, but I just thought it was interesting on the value side that, hey, there are a bunch of schools in here. We think of the California system as sometimes not being that good. We all live in California and know the problems of the state. But you got Cal State University Los Angeles, Cal State University Fullerton, San Diego State, Cal State Sacramento, Cal State Monterey, and of course Cal State Fresno that are all on this list. You got one UC, which is UC Irvine, not because UCs aren't great, but because, again, this is value. They cost more. And then, of course, you got your Ivy League schools and your Stanford and your Princeton, because while those cost a lot, those people typically come out and do pretty well. So it's just a good barometer. Again, this is just one barometer, but I thought it was interesting. I would never have guessed that there was that many state schools from California on a best value list. So,
well, again, from a planning perspective, when we talk to parents and grandparents about college planning, in-state tuition especially in the state of California is extremely valuable. It is in all 50 states, really. If you're going to send your child out of state or grandchild out of state for school, the difference between an in-state and out of state is in most
massive.
cases at least 3x, maybe 4 times as much money. And so, what's, again, to your point, what's the value in going out of state 5 states away, paying 4 times what you're going to pay at, Fresno State or San Diego State or whatever, and what are you going to come back with? What are you going to really end up with at the end? Are you going away just for a college experience, or are you going away to prep for career and the rest of your life? So
yeah, along those lines, super similar. I mean, I'm heavily involved in athletics, and everybody, especially nowadays, wants to quote their scholarship. I got this much in scholarship. I got 20,000 in scholarship. Well, if the school costs 50 and you got 20 in scholarship, that sounds to me like it's 30 grand. You can go to Fresno State for 6. I'm not saying that you don't go to the school that, maybe it's a great school, maybe it's a perfect fit, maybe it's got your perfect major. Like, all those things are factors. But we tend to look at one side of the equation a lot, either cost or, in this case, free money scholarship. And private schools by nature they have to give out scholarships because people can't afford to, unless, again, you're a Stanford, that type of school. Most people are not going to pay $50,000 to go to school there. So they give out some scholarship money. But those Cal State schools, obviously, I think Fresno State's tuition is like $6,000 or $7,000. So
yeah, it's right in there. It's not, again, if we think about value, what are you paying to go to school? The numbers that I see thrown around that cost $250,000, or kids coming out of school with $200,000 in undergraduate, so a bachelor's degree, coming out with $200,000 in debt is just wild to me, and I don't understand really what sort of math goes into that, or why you would want to take on that much amount of debt if you're coming out with a bachelor's degree. I have a hard time suggesting anybody do that. That's a rough one.
Yeah, no, debt is, as we can see, there's a lot of kids out there with student loans and having a hard time paying it back. So anyway, we just thought that was interesting. Again, it's something we talk to clients about with investing, the net, and like we talked about with the Secure Act, putting money away into 401k plans, all things you could take advantage of and save money on tax. Again, keep more of your own money. Those are all positive things. So that college graph just kind of struck me. I was like, man, this is exactly what we talk about. Like, where am I going to get a good value for my education versus how little am I going to pay, or how prestigious is it going to be?
We should think about having a guest come on to talk specifically through financial aid and the rest of that too. That would be probably a good, half an hour type topic to tackle, especially right now. So it really is the season for college applications and financial aid applications. So, that's probably something worthwhile doing, and just looking at what's coming up too. So next month, I think in October, we have another one of these abbreviated sessions, right? Monthly Market Matters.
Yep.
And then the quarterly roundtable in November. Again, just off the cuff, we haven't talked about this, but we might want to just push out to early December if we have a different setup to be able to do that in. So
for sure,
that might come a little bit later than it usually does. But we'll do it mid-quarter for sure.
Well, I think that's taking up enough time for just for a quick monthly recap. Hopefully you got some good insight out of it. As always, reach out to us, with any questions, information, anything you want to talk about. I said Secure Act was a great thing to mention. And we're always here, and we actually like talking to you guys. We look forward to talking to our clients. So again, until next time, we'll do this again next month. Take care.